David, we're looking at the NASDAQ up 233 points at the moment. That's a record. S&P at a record. And let's just go with, as we look at those indices, and we'll cycle through the pictures here, the charts. Let's talk about gross domestic product. We just got the second print of first quarter GDP, and it was not pretty. Tell us how to interpret that.
Yeah, I wouldn't worry about it too much. I mean, overall, the economy is just growing slowly. It's a weird kind of economy here because it is not nearly as bad as you think looking at consumer sentiment, and it's not nearly as good as you think looking at the stock market. And so you've got an economy which is moving forward. We actually think growth will probably pick up a little bit in the second quarter. We do have all those income tax refunds, even with, and we've got all this AI tech spending, which is helping power the economy forward. So I think the economy is growing okay. I mean, I think we'll do a little over 2% growth this year, but you still have to ask questions after 3 absolutely sparkling years for the stock market, and now we're in the middle of a fourth.
Yeah, double-digit percentage gains at the moment. We'll see if that can make it a four-peat. But if you look at the first quarter Q1 GDP revision here, it came in at 1.6%, the expectation, and the prior read of the same one, 2%. And yet the Atlanta nowcast, so the Atlanta Fed puts out this nowcast, which is sort of the in-the-moment GDP. They have it way higher. It's something like 4.3%. Is it somewhere in between? What do you think?
I think it is. I can't get their numbers, but what's going on is it's a pretty wonky thing. What's going on is we know that there's been a huge increase in the price of energy and during the second quarter. Now, the question is, when you see a big increase in inventories of energy, is that because of an increase in the quantity, or is it an increase in the price? And I think the Atlanta Fed model probably doesn't quite get that right. And so I'd take the under, definitely, on the Atlanta Fed model. The economy's not that strong. It's, as I say, I think it's maybe growing at a 2% pace, maybe a little bit above that in the middle of the year and then slowing down later on in the year. But the economy is a boring story here. The market is exciting. And
that's true, but it's not boring if you're having to pay higher prices. And that PCE number that we got, in the deeper parts of the personal expenditure and all of the spending and then the actual income looks, there was a dichotomy, there was a split there. People are making about the same, and yet they're spending more because they have to. Things are more expensive now. And when you look at that comparison of basically, personal income versus consumption, what does that tell you? And I don't mean to be negative at all. It's just that these are the numbers we have to work with.
And I think it's the huge gap between Main Street and Wall Street. I mean, we don't just have a little K economy. We've got a capital K economy where it's almost a tale of 4 cities. You've got AI and everything else. You've got the rich and everyone else. And that's really what's going on here. And I completely agree with you. I think 60 or 70% of American households are paycheck to paycheck, and this increase in gasoline prices and all these other prices really hurt.
We should be showing some consumer discretionary stocks, consumer staples, because suddenly people are going into those names, especially the staples you would think might be doing a little bit better these days as people will buy what they have to versus what they want to.
Well, yes, but of course then they'll trade down in terms of brands and buy the cheaper version of this so that the profit margins get squeezed. I think companies that are selling to the great mass of consumers are having trouble today.
Can I just quickly point out that today the St. Louis Fed President, Alberto Musalem, made some comments because everybody wants to know, will the Fed cut rates or will the Fed be forced to hike rates? I'd like to know your thought. But Musalem came out today and he was giving a speech and he said there is a scenario where the economy might require a rate increase. That's very much Fed speak. Might, maybe, we have to watch for the data. But he said the risks are now tilted more to the inflation side. That would mean, if you're interpreting basic Fed speak, that we will not see a cut and that we will see possibly a tightening.
I don't think we'll see a tightening, but I think the Fed in general is circling the wagons here around the new Fed chair to try maybe take a little heat off him, so that when he gets into the job in the June meeting and there is no cut in June, the Fed should be unanimous in saying there's going to be no cut, because honestly, you talk about that inflation number, it's basically double the Fed's 2% target, and you've got unemployment at 4.3 and their goal is like 4.2, so we're basically there. So you look at the data, there is absolutely no reason for the Fed to cut rates. Now, it wouldn't make sense to raise rates either, because why is inflation high? It's because of a supply-side shock coming out of the Middle East. Once this situation is resolved, however it's resolved, and oil gets flowing again, I do think that inflation will ease a bit. But the other problem with cutting rates right now is if you cut rates, you give even further fuel to the stock market. Frankly, I think the stock market is exuberant enough right now.
It's doing just
On its
fine
own,
amid
exactly.
all of these crazy headlines.
You don't want to encourage it. I mean, the job of the Fed has always been to take away the punch bowl before the party gets out of hand, and this is a pretty rollicking party going on Wall Street right now.
Okay. David, welcome back. It's great to see you.
Anytime. Glad to see you.